Hello, everybody. Welcome to Chapter 7. And today we're going to get into trade management, right? So, now trade management, this is the third part of those three keys to being a consistent, successful, winning trader, right? Which again is going to be trade analysis, trade execution, and now trade management. This is the third and final thing that you need to become consistent in for you to be a winner in trading, okay? So, now trade management and what I'm about to teach you guys and how I use trade management techniques with my methodology and or how you can use it with your strategy and how you trade was designed for you to be able to maximize on the amount of profits that you can make per trade and at the same time being able to secure your profits and knowing when to exit a trade if it's not going to fully go in the direction that you might have expected it to. Okay? So, in doing so, you avoid the problems that people face when they are in a trade and it goes up in profit and then it ends up coming back down to break even. You make no money, or it goes deep in profit, you're up a fairly decent amount, and then comes back down at stop loss. So, using these techniques will avoid scenarios like that. Also, you will know exactly when and where to get out and what you're looking for to tell you or to be able to understand that the market is telling you that it doesn't want to go in your direction anymore. Okay? So, jumping straight into it, not to waste any time, we look at trade management. Here's four guidelines that you want to follow when we talk about it. So number one, you want to at least go for a 1 to 2 RR minimum, right? Because that just makes sense. You don't want to, if you just take 1-to-1 trades all the time, you have to be at minimum 50% accurate for, I'm sorry, 51% accurate for you to be profitable, right? But if you're going for a 1 to 2s minimum, all you have to do is be more accurate than 25% of the time and you will be in profit, okay? Number two, you have to hold until there is a break of structure, and we're going to look at 5 live examples where we're actually going to be exercising these rules. So you want to hold a trade until there's actually a break of structure. And what I mean by that is this, right? Say you are in a trade and price is down, and let's say you enter right here. Okay, this was your entry point. You need to be able to hold your trade until, where's the, that's what I'm looking for. You want to be able to hold your trade until you, bear with me, guys. That's our entry. Once you enter a trade, you have to stand until you see a break of structure. Okay? You want to see price actually decide what it wants to do first. And you don't know what price wants to do until it either breaks structure above or breaks structure below. So you need to see that first break of structure. Okay? This can happen, this, it can do all this, it can make all this noise. But you're gonna hold, you're not gonna close, and you're not gonna look to exit until you see a break of structure. Once you see that break of structure, okay, now you can look for your exit techniques, your exit confirmations for you to be able to get out of this trade. But you have to wait for the market to decide what it wants to do. During this phase, this is the market deciding what it wants to do. And we're going to see some examples of that. Okay. Number three, your TP levels are going to be point of interest in the market. Those can be highs and lows, supply and demand zones, or fair value gaps slash imbalances, which I'll cover briefly, but there will be a different video teaching you guys what fair value gaps are. And number four is going to be, you'd be using order blocks to guide you through holding. Order blocks are simply supply and demand zones, but on a smaller time frame, on a smaller scale, and you typically look for those when you're trading a current move. So if you're basically looking to take another trade, or you're executing on within the same move, within the same leg, you wait for the market to pull back to these order blocks, which I like to call reload order blocks sometimes. Those are what you'll look for to determine when you should keep holding. Okay, so let's jump into our 5 examples. Number one, we're gonna look at AUD/USD. We're gonna go back to February 6th. Okay, so let's have a look. skipping over, going over, the actual strategy or how we identified this trade. We see price reach this demand zone, and from this demand zone, we would enter this trade right there. There's the entry. Okay, so once we get into this trade, you want to do is the first thing you want to do is you want to mark your take profit levels, right? Once you enter, you mark your take profit levels because these are the areas that you're going to be looking to potentially exit your trade. These are your points of interest. So when we talk about highs and lows of the market, right? You want to mark those highs and lows that stand out. Just remember this: the market moves in levels. I'll type it here. The market moves in levels. Okay, the market's gonna always go from one level to the next level to the next level. So just understand that the market moves in levels. So when you mark your TPs, you want to mark these levels. Now, here's what I do when I mark my take profits. Majority of the time, I do it from the bodies, right? I mark the bodies of these highs and lows, not the wick, the body, right? Because in marking the body, I'm able to exit from what would be the opening of a supply and demand zone, right? Because technically, these wick areas are supply and demand zones. So what I do is I just mark the body, and these are called flat tops or flat bottoms if I do this on the bearish side. Anyways, these are our TPs, meaning that when price reaches these levels, this is when I would be looking to see what my exit strategy is and when I'm going to use it. So as the market goes, again, we don't think about getting out at all until we first see that break of structure. Okay, that first piece of structure has to break before we can even consider getting out, right? The market could have done all this, but I would still hold until that structure is broken. Okay, so there's our break, right? So now that we got that break, let's see where we're at, our risk to reward is at. So right now we're up 1 to 3. So at this point, this is good enough to close if I see any sort of candlestick rejection, right? And let me just make this the key indicator of when to get out. You exit when you get reverse, when you get a reverse candlestick confirmation. Okay, so obviously if you're trading in a bullish market, you're buying. If you see a bearish candlestick confirmation at a area or a level of interest, that's when you exit. Okay, so we let this trade go, and now here's how you justify holding a trade when it starts to pull back on you, right? And now we're going to get into order blocks. So order blocks are simply when the market pulls back to these interior levels of supply and demand, right? You see this push down before the continuation up that's within the same move. These are your order blocks, okay? And this takes the stress off of holding because now you're able to understand that the market was just pulling back to this order block to reload back up liquidity so that it can continue to push forward more, right? And in this case, it came back to the extreme down here, right? Because this is also an order block where we see this impulse that broke structure. It's the same thing as supply and demand. Same thing, just on the on an internal time frame. Like we're looking at these within the actual move itself, right? So we see that price came up, and then it pulled back, went into that zone there, and now it's starting to go in our direction. Okay, so boom, look at that. And just so you guys know, when I trade, I don't use take profits. I use, well, I'll exit manually upon getting a confirmation that tells me when to exit. Okay. And the reason I don't use take profits is because, you want to take what the market's going to give you. You want to take what the market's going to give you. The market wants to give you 1 to 3, 4, 5, take it. If it wants to give you a 1 to 6, 7, 8, take it. The only time I would use take profits is if I'm walking away or I'm outside or I'm not in a position to monitor the charts. Then I would use the take profit level, and I'm probably just always going to go for the first one because I can't monitor it. Okay, so now at this point, we see that price is in our favor. So and we just reached this level. So what is going to be our exit confirmation? That's going to be when we see this, right? And usually I'll drop down to the 3 minute time frame when I do this. A candlestick confirmation that's in the opposite direction, right? This is a bearish candlestick confirmation. I'd call this a bearish harami. And because this bearish harami occurred at this level of interest, that can mean that the market is reversing now at this high and is going to start to go back down. And at this point, there's no more reason for me to hold because I achieved my minimum target of 1 to 2. This trade is actually up 1 to 5. And this is basically going to be the end of the trade here. Like it's just, you want to keep it that simple. Price gets to a point of interest, higher or low, supply or demand, and if you see a candlestick price action confirmation, reject that area, you close the trade. Okay? Don't worry about trying to make sure you catch it up here because the market can pull back a little bit and then give you more. So you want to wait for that price action confirmation to tell you when to get out of that trade. Okay? And as you can see, if you didn't close that trade here, this is what would have happened. You would have had all of your profit just retrace away. And you probably would have closed down here because you were up 1 to 5, and then you would tell yourself, oh, I don't want to break even, or I don't want to take a loss. And you would have closed here. Okay? So don't push it. Don't push it and say, oh, okay, well, it didn't make a move off of this. It's probably going to make a move off of this. Don't do that. Because if you had done that and said, oh, it's probably going to make a move off this breaker block, it did not. It's not a guarantee, right? That's basically the same thing as saying you're taking a new trade. And because you're taking a new trade, that's a new opportunity to lose. Once price reaches your point of interest and shows rejection, you exit. As long as you're up at least 1 to 2, 1 to 2.5, or whatnot. Okay? Next example. Let's head over to EUR JPY. Okay. So this is a setup that has some inducement on it. All right. So we're waiting for price to come back to our point of interest, which in this case is a pretty wide one. But because we have that inducement, we can use it. So per usual, that first touch is going to be some form of manipulation. We wait for that to occur. And then we'll get in. So right here, this is going to be our 5 minute time frame. This is going to be our entry. We're entering off of this harami. Now, getting to the point here, this is where we get in. Now, like I said, once you enter, you want to identify your highs and lows. Okay, here's the next level. And here's the level after that. And if you want to go further and further, you can, but you're most likely not going to get this much movement without a pullback, without the market pulling back and retracing. So let's see how this goes. I'm going to drop down to the 3 so we can get better visuals. So this market goes, we're in profit. This trade is not going to be considered a winner until we see a break of structure. Once we start breaking structure to the upside, this trade is probably going to go to its take profit. Okay. So once you're in a trade, there's going to be noise. Okay. The market's going to move up, it's going to move down, it's going to pull back, it's going to do whatever it wants to do. You have to be able to see through the noise and understand that that's just how the market moves. That's just what the market is doing. Okay. In this case, you broke structure. And like I said before, you don't even think about exiting until that first piece of structure is broken. However, the market breaks structure, then it begins to pull back. You might concern over, oh, should I close? What is it going to do? So this is where it comes down to understanding how order flow works, how order blocks work, and fair value gaps. So right here, what we see is these consecutive blue candles. There's there's an imbalance here where basically there's a gap in the market that needs to be balanced. And put it short, the market usually is balanced. It needs to move. It needs to be balanced. We have bearish movement, bearish, bullish, wicks, and everything else. However, sometimes you'll get these impulses in the market where there was no opposite side price action offered, right? This is what a fair value gap is. This is what an imbalance is. And what tends to happen is the market pulls back to these imbalances to grab more liquidity and then continue on its way up, right? Which we can see happens here. The market goes into that imbalance and then continues its way back up. All right. So understanding that is how you're going to be able to have the confidence to hold your trades when they're happening, right? Because when you see the market pulling back, you'll be able to identify and say, okay, the market is just pulling back to this fair value gap to grab some more liquidity and then continue back on the way up, right? Where look exactly what happened. The market comes down to those levels, grabs that liquidity, and then continues going up. Or better yet, you could even say that the market came back to this order block here on the 5 minute time frame. The market came back to this order block and then continued to push up, right? The market wasn't reversing on you. It was just pulling back to reload on liquidity to continue to propel the market back up. All right. So now we're still in this trade. This is why we don't use take profits and we wait and see how much the market wants to give us. What if the market wants to give us a 1 to 5, a 1 to 7, right? So I'm just dragging my level up to this high here because this is the next level beyond that. Whenever you're looking for your levels, you just look left. Just look left. Keep it extremely simple. You just look left for the last higher low that's there. So my exit is going to be if I see some sort of candlestick confirmations that oppose the direction that I'm trying to make money in. So look at that. Price touched this point of interest, and then I get this bearish candle. However, this is a doji. This is an in-between neutral candle. So I'm going to hold it for one more. This is a bullish candle, but I mean I am seeing that rejection on this area. This is almost a pin bar. It's not quite a pin bar. Let me just double check. If I was going to classify this as a pin bar, the wick has to be at least 2/3 of the entire candle from wick to wick. It's almost 2/3, but not quite. So I'm gonna hold for one more candle. All right. So this is the point to where I'd actually be exiting the trade. And perhaps you could have exited here if you wanted to play it safe. But if you're just following the rules to the T, you'd be exiting this trade once you got that bearish candlestick confirmation that goes in the other direction. So this trade you would have left with a 2.4. Okay, and again, using this for your exit techniques will in the end leave you with more profit than if you were to just go for 1 to 2s or 1 to 2.5s or just set the first take profit when you take your trades, right? This is how you're actually going to be able to maximize on that impulsive movement that the market provides. Okay, let's just see what happened with this. Okay, so look, this is exactly why you want to exit when you get that confirmation. This is exactly why you want to exit once the market shows you evidence that it doesn't want to push past that point of interest or that level. Okay, third example. We're in an NZD USD, January 24th. Alrighty. So as we're looking at NZD USD here, what we're going to see is this. Price is bullish and it's about to pull back to a breaker block here. And this is where we're going to take our entry. Okay. So price reaches the breaker block. There it is. And I'm just going to skip to the point to where we are in the trade. All right. So we enter right here after that bullish pin bar, and now we're in. So again, all trades are going to be held until at the very least you get that first break of structure. After that first break of structure, then you can start to mark those next TP levels, right? Those next highs and lows where the market can potentially reverse at. Okay. And other points of interest. For example, there's an imbalance right here. You guys see this huge bearish candle with no wicks in between, no bullish movement to pull back on. This is an imbalance. This is a fair value gap. The market can potentially go to these areas. Okay. Anyways, as we're watching this trade, you want to be able to understand what it's doing. Price is never going to move in one straight line, but you have to know what's going on and when it's going on, right? So right here, price came very close, and watch this. Although you're up 1 to 2, and you might be tempted to close because you're up 1 to 2 and you're seeing rejection at a high here. However, the market hasn't decided what it wants to do yet. If you were to close right now, you'd be cutting yourself short because the market hasn't even broke structure yet. It hasn't even broke structure. You don't even know if your analysis was correct or not because the market hasn't even made its move yet. So in this case, although you're up 1 to 3, you should still hold your trade because you did the work already. You want to see what happens. Okay? So this is exactly what I mean by I would continue to hold this trade until there is a break of structure. And look at that. There's our break of structure. So now that that happens, now I can start to look to exit my trade once it hits any of these next points of interest. So if we're trying to understand what the market is doing right now, we see it's pulling back, and what we're looking at is this, right? Or what I'm looking at is this. I see that there's a imbalance here, this fair value gap here, or it could be coming back to this order block down here. Okay, and I just draw these out so that I'm able to hold comfortably, so that if the market's pulling back, I can see that it's probably going to go to one of these zones. And mind you, the only reason why these order block areas are successful is because my analysis was correct. If your analysis is incorrect, the market can just violate these points of interest that you're using for the market to continue and just decide to do whatever it wants to do. As we can see, price came back to this imbalance here, this fair value gap, and decided to continue forward. And we're still holding this trade. At this point, we're up 1 to 5, and we're still holding. Again, we're going to take whatever the market wants to give us. Now, this is something that we would look at and say, okay, the market is now potentially reversing. But honestly, instead of pushing the holding technique and saying, okay, well, maybe the market wants to pull back to this order block here and continue forward, you don't need to do that. Matter of fact, you should not do that because you're already up 1 to 4.6, which is double of your 1 to 2 minimum target. In this case, because you're getting this bearish engulfing candle at a point of interest that you had marked, you should be exiting and getting out of your trade, right? You don't want to rely on these order blocks for you to continue and collect more profit after you've already hit your target. That's the psychological part of this. Once you're up your 1 to 2 plus, you need to exit your trade at the next price action reversal confirmation that you get once price reaches one of your take profit areas. Okay? There's no reason to push it and chance it because, as you can see, you don't know if that market's going to go all the way back down to entry or to stop loss, and you don't want to get stuck in that trade. right? You want to get your money and get out. But for fun, let's just see what happens here. See, look, if you were one of those guys that said, okay, well, there's this level and there's this level, I can make double. You would have tried to hold at this order block and you would have seen that it gave you some movement and then it crashed down. And because you were wrong, and just because you were wrong and you lost the money that you just had, you'd be closing right here like a sore loser, right? So you got to have the discipline to be able to close your trades when you see these price action confirmations at those points of interest. And the only metric you want to use is that you're walking away with at least double of what you risk. Okay? Last two examples, we're going to go to ADJPY. Okay, and this was, and by the way, all these trades we're looking at, I get all this stuff from the Discord channel, guys. Like I get all these everything that you see in every single video that I've put out in the case studies, um, the academy videos, they are all trades that I have actually sent out in sharp markups and showing you guys what I'm doing in real time. Okay, so this is a trend break. This is a trend break model here. Price broke out, broke structure, pulled back, and I was trading this supply zone. All right. So, anyways, price comes back to this order block around the 5-minute time frame. This is one of the instances to where we don't have to wait for manipulation because price is pulling back to its zone within 4 hours. I call that an immediate pullback. In those cases, you don't have to wait for manipulation. You can get in as soon as you get that confirmation you're looking for. Anyways, we would enter right here off this bearish engulfing confirmation. Our first take profit is going to be here. Okay, because that's a 1 to 3, right? And the next level beyond that is right here, right? And even here is a final level. Okay, these are all areas or points of interest that I'd be looking at to close my trade if I see rejection. That's it. If you see rejection at a point of interest, close. As long as you're up at least 1 to 2. So, and again, guys, I do this on the, because I enter on the 5-minute time frame, I usually do these exits on the 3-minute time frame. Right? I drop down because I would want to get out sooner rather than later. I would rather have less of my profit retrace away when price is rejecting. Sometimes it rejects pretty aggressively, so I'd want to get out sooner rather than later, right? Waiting for a 5-minute candle close is going to take longer than waiting for a 3-minute candle to close, and that can retrace more profit potentially. Anyways, because there's no break of structure here until the market were to break this level, right? This would be our break of structure. In this case, though, we don't even need a break of structure to achieve our target. I mean, we could wait for it. The market will probably break structure if your analysis is correct. But if there's a point of interest before that, right, which is going to be this demand zone right here. Did you guys see that, by the way? You see how this demand zone is actually that flat bottom that I marked here on the 5-minute time frame. That's why I marked these highs and lows at the body instead of the wick, because the market can reverse as soon as it touches that demand zone. Anyways, there's that first take profit that got hit. Okay. Now, watching this continue, let's say you got in a little later and you were not up 1 to 2 in this case, because in this case is pretty close. Or let's say you waited for that candle. You waited for that candle. This, if you got in a little bit later, you could have not been up 1 to 2. If you needed to hold, you would look at, well, what I see is this fair value gap here, and what I also see is It's order block at top. So if the market's pulling back on me, I'm going to say, okay, it probably wants to pick up some more liquidity from these order blocks. And you only do this when you have to. If you're up your target, you don't wait for the market to pull back on you and retrace on you. You're just potentially losing profit, right? You only do this if you are not up your 1 to 2. You're not up your 1 to 2 minimum. You don't. You. This is when you do this. If you're up 1, 3, 4, 5, 6, 7, you don't need to do this. It's just not necessary for you to have to do this. And so look, price came back and now it went all the way back down to that last take profit level. Okay? Look at that. It went straight through this one, came down to here, and now this is where we're getting that rejection here. See that bullish rejection? That's where we'd be getting out of the trade because we see that bullish harami right after price hits that POI. And so let's move on to our last example, AUD USD. Now, this last example here is the reason why. This is the sole purpose. Well, let me not say the sole purpose, but this is a prime example why this trade management technique stands out the most, because it allows you to capitalize and take whatever the market wants to give you, right? Especially if there's some big liquidity that gets injected into the market, right? Whether if it's the ones you do know about, like 8:30 a.m. news in New York session, or if it's the ones you don't know about, which is someone just injecting liquidity into the market and you catching this huge move. Okay. So, anyways, you guys will learn more about this in the video where I'm going to talk about fair value gaps. But basically, when there's a fair value gap, again, price is usually balanced, as you can see. A lot of wicks, a lot of bullish and bearish candles. However, there's a gap here. You have white candle, white candle, white candle, white candle, white candle, and then this one here is just a space in between. What you would do in a scenario like this, don't attempt this before learning how to actually do it. But this would be where you'd be looking to take a trade if you see a fair value gap roughly in the middle, right? The mean threshold of it. And let's let the market catch up a bit. Okay. Look at that. Right? This is bonkers. This is bonkers. So as soon as price activated, right? Now imagine you had a imagine you set TPs. Imagine you set TPs. You would have been out right here, sharp. Right there. Done. That would have been it for you, right? If you said take profits, you would have been out right there and you would have had nothing else, right? And you would have had to gone through the agony of watching something like this, right? This is why this trade management technique is probably the most profitable if used correctly, right? You are not losing profit once you're in profit, because you exit when the market shows you that it doesn't want to continue no more, right? And here's the last thing that you guys can learn from this technique. Let's say there's no structure, there's no space to the left, there's no levels, right? And the market just dumped. I'll be honest, if the market dumps like this and does something crazy like this, you should close as soon as you start to see rejection right here. But let's just wait for our candle. What you would do in this case is you would wait for you would still wait for that candle, but there's no point of interest to use it off of. So at this point, you really should not care where or when you get out of this market. As soon as it starts to pull back on you, please close. You're up 1 to 16. Don't test it. Don't try it. Don't try to see if this market is going to go down to the ground. Don't try to do any order block plays and try to find out where the market is going to continue from. This is where you will just exit the trade. See right here, if I'm on a 3-minute time frame, I'd be exiting right here, and I would have been going home with a 1 to 10, right? But let's say if you're on the 5-minute time frame holding, you would have exited right here, right? Look at that bullish harami. This is what your exit would have been if you were waiting for 5-minute time frame candlesticks. Okay, and so it's basically all you need to know in terms of trade management is concerned. So once again, 1 to 2 are our minimum. You have to hold a trade until it breaks structure, right? Let the market decide what it wants to do. Let it breathe, let it make its decision. Once the market breaks structure, now you can look to exit upon the market hitting those TP levels, which are points of interest in the market, such as highs and lows, supply and demands, fair value gaps. And if you need peace while holding and want to understand market movement and market noise while holding, that's when you use order blocks within the trade to guide you through that holding process. And finally, you will exit the trade without thinking. That's the most important part. Without thinking, once you see that price action confirmation that goes against your trade at an area or point of interest. Okay, so I'll wrap it up with that, guys. That's trade management. If there's any questions, feel free to send me a private message and I'll get back to you as soon as possible. So I'll catch you guys on the next one.